Hi guys, welcome again to another lecture. Really good to see all of you guys here once again. So today we are going to look at something completely different, right? So I know through the lecture series I've covered a lot on currency and occasionally on agricultural commodities, crude oil, gold, but I haven't really covered a lot on equity indices. By that I mean the S&P 500, the Dow Jones Industrial, and also the Nikkei. So I've got some of these up here and we're going to look at them. Now what I find with indices is that we've got a lot of nuance, right? Not all indices behave in the same way. For example, in the case of the Nikkei, it's an index that has gone very sideways. It tends to mirror the S&P 500 and the Nasdaq in terms of its movement, but it's a market that tends to go wildly up and wildly down, and you're going to see that obviously, when we go through the profile on the Nikkei. And then you've got obviously indices like the Dow that tend to have quite clean directional movement, but on the other occasion decouples from the S&P 500 or the Nasdaq. And then we've got the Nasdaq, which is a little bit wilder. For me, it tends to deliver a lot more like a commodity, like maybe crude oil, for example, or gold. So you get these huge directional moves with the Nasdaq up and down, right? And then, of course, which is why I presume a lot of traders love to trade the Nasdaq. And then, of course, you've got something like the S&P 500, which tends to be, I think, more or less the standard for index trading. Obviously, no disrespect to the FTSE, I've mentioned it, but again, the FTSE looks a lot, in my opinion anyway, the FTSE looks a lot like the Nikkei. It can behave a lot like the Nikkei. So with indices, because I find there's a lot of nuance, I like to tackle them all individually. And if you're an index trader, it's unlikely you'll trade the Dow, you trade the Nasdaq, you trade the S&P and the Nikkei. More than likely you'll pick one thing and then you go towards that, and that's the thing that you're probably going to trade for the rest of your trading career. Unless something, of course, prompts you to change. I myself, of course, I'm not a huge index trader. If I see an opportunity on the index, I will take it. That said, for those of you who followed me over the years and have seen my trades as well, and the things I look at, you would ultimately know that it's not a big deal for me, right? I don't trade the index a lot. I focus a lot more on currencies, as you would know. So I'm big on FX, so I've got a lot of FX positions that I've taken, and you'll also see that I've taken a lot of positions maybe around gold, for example, or agricultural commodities with a couple of crude oil trades in there as well. So for me, I'm kind of very siloed. Most of my trades come into cables, so definitely you can describe me as an FX trader as opposed to some of the other kind of trading that exists out there. Of course, that being said, a lot of people look down on FX, which I find really strange, to be honest. Volatility has come out of FX over the years, absolutely correct. So you don't get the same volatility change as it like you would get in some asset classes, like for example gold, that's drawn in a lot of volatility over the more recent years. And the way you've got to look at this is that volatility comes in and out of markets. So it doesn't really matter if today you're an FX trader and volatility goes out of FX and you decide to move to a different asset class. I think the benefit of working with a market profile, for example, it allows you to view asset classes in terms of distributions, right? Price distribution. So you're not really focused so much on the asset class itself. In financial speak, it's just a product. What you're focused on is whether you understand that product and you understand the behavior of that product, and trading that product, will it bring you return? Will you make money? And if you can make money trading a product, and you've got a means to look at all the different products and decide what products you want to go towards, and that's an amazing thing. And I think that's what Market Profile ultimately brings to the table. It gives you the ability to look at a product and say, I don't care what you are, I can look at your distribution and I can figure out a way to trade you profitably, right? So in other words, it's like you being a merchant and you're taking on a new product line. You want to understand that product line in depth so that you can sell it to the customer. And that's essentially what you're doing as a trader. Is if you pick up something like an index, for example, you want to understand the index product so that when you go to trade it, it can be profitable to you. So when you start selling and buying from people, you're doing that in a way that's going to be beneficial to you. So in my case, that's how I look at markets. I look at them in terms of the market offers different products, and which one of these products can I figure out over time. So a lot of my journey as a trader has been around unpacking and figuring out products so I can trade them effectively and make money. And if there's a product that ultimately I can't figure out a way to make money in that product, then I just take it off my roster, because obviously whatever the product is, it's just not really, I'm not able to find a way to make money out of it. So I've traded most things, almost everything, and the reason for that is that I've wanted to find out if I could make money on all these different products if I needed to. So if there was ever a time when my dominant product stopped being a profitable product, or my dominant products changed its behavior, or volatility left it, something essentially crushed that, I'll be able to pivot and do something different. I think people in the stock market would identify with this a lot more, because in the stock market arena, you've got small caps, you've got large caps, and these are all in a way different products in themselves. And since these are stocks of individual companies, this is probably the largest individual products market space. And a lot of traders may have started their trading journey trading small cap stocks, and then realized at some point that small caps were no longer beneficial, or those products you couldn't make money on them as well, and then they moved to momentum stocks, right? And then later they realized that maybe momentum stocks didn't offer what they were looking for over time, and then they moved to large cap stocks, for example. So I'm sure that group of trader can appreciate what I'm saying when I say that the product that you trade is most important, in the sense that you want to be able to figure out how to make money in that product. All right, so moving on. I'm going to start today this lecture with the Nikkei, and then we'll go around. So there are two aspects I'm going to focus on. So when you're coming to trade an index, there are two things I find are constant. And like I've always said, that part of developing a good trading idea, a good trading strategy, is to find something that consistently repeats. Once you can locate that, you can really hone into it, and then forget about some of the other areas of the product initially, and then hone into that particular thing that continuously repeats itself, that you can start to build expectancy and edge around. So I find the profile is really easy to use to do this, right? Because it brings out a lot of statistical benchmarks and puts it right in front of you, in addition to obviously normal distribution, i.e. normal price action. Right, so first and foremost, at a glance, you would notice that I've set this profile up, and there's certain parameters I have in place. For example, I'm going to split this rotation and use it as an example. So on this broker, I'm starting this profile at 0300 hours, which it's plus 2 GMT, so it's 0100 hours, generally speaking, when we link it to London time. So what does that mean? It means that this is the primary time that the Nikkei opens and does its move. It's open before 1 o'clock London, but all the big moves are going to start at 1 o'clock London. This is a repeatable event, right? It happens all the time. 1 o'clock will come, it repeats, and every 1 o'clock we're going to get a big move on the index, right? And essentially for me, that's the initial balance, right? The first hour trade. So once we've nailed down that first hour trading on the index, well, we've got an event that typically repeats. Now we can start to hone in and set parameters around that, but we'll come to that, right? So, but this is the first thing that stands out to you, is that you can say that there's an initial balance, and that always happens every single day. The other thing you notice is around the initial balance is that something also happens once the balance is formed. The first thing that happens is we could break out of that balance, right? And once we break out of that balance, we essentially might revisit prices within the balance, but ultimately we expect the market to go in the direction of the balance break. Now, of course, that's not always the case. Sometimes the market opens a balance and doesn't go in the direction of the break. I think this is a good example where we try two sides of the balance, and essentially we go in the direction of one side. So that wasn't decisive. Obviously, in the case of this day, it was a little bit more decisive. We break the balance in B period, we trade the first leg of the balance, and then continue in that direction. Again, if we use today as an example, this is a very wide balance. So we traded out of the balance, wide out, and then we broke the balance, and then essentially we've stayed under the balance since. Now this has caused a lot of traders to see this as a repeatable event, and how can they manipulate it, because that's the point. So again, with index-based products, I find they're very heavily traded. They're used for different purposes. For example, it can be hedge portfolios, and so there's a lot more strategy built into these kind of products. And as a result, people who trade these are primarily looking for an opportunity to essentially game the system, right? Is there a weak point? So one of the weak points you're always going to see when you associate that with an index is when we break in the direction of the balance, we tend to keep going in that direction. So if I have that piece of information, for example, let's take today, and I see a big break like this on the balance, and then we punch it out in D period, well, my instinct is to either wait for the market to rally back in to into the range of the balance again and save a few ticks, and then short the market for a downside move, right? Or I could trade the balance break and just continue in that direction for a small profit, right? So those are some of the nuances that occur. So you'd find a lot of traders would essentially wait on the end of balances to trade them short and make little small scalps out of it on a day to day. So they might put a figure and say, I'm happy to take day to day, this particular thing would happen 80-90% of the time, so I'm looking to take really small chips out of it, and if there's a big move, essentially I'm gonna get out of the trade once we're the other side of the balance. So that will prompt traders to look for strong balances to trade in that direction. So for example, we can see a strong balance here. If I see a strong balance like this, I can assume that on a break of F period, I'll trade it a little bit in and I'll short, and I might take about, in this case, for example, 29 points out of the index. Or it might be, I trade this lower and then I take 20 points out of the index. Whatever it is, right? Maybe that's what you've measured statistically that the Nikkei can do. I've got some figures around this, right, in terms of how far it can move, but I'm not going to get into that right now. That's something that I tend to reserve for people who, obviously private clients, people who are essentially with me and I'm trying to mentor them through this kind of an experience, right? So this is more down the route of strategy building. Again, you can say that on this day here, quite similarly, we had a strong balance, right? And then we broke out that balance in H period, and again, as we dip slightly lower, we could push this for 20 points. Again, here's another example of a strong balance. Again, we had a strong balance out. Unfortunately, this balance did not continue. Instead, we pulled way back and then eventually broke much, much lower. But if you notice, this balance really did hold for quite a few days. So strong balances, the point is strong balances tend to hold. Now we can continue to review this data as well. So here's another example where the balance didn't go the same day, but ultimately, again, we broke it in E, pulled back a little bit in E, and again, if you shorted this, you would have probably gotten 20 points out of it, to be fair. But let's say, for example, that you couldn't do that and the market pulled back, we were able to get that the next day. Obviously, this wasn't a strong balance, it was less of a print, so even though we got a decline, you can see this balance was vulnerable to being traded above, right? And this is a nuance, right, that we're building and seeing consistently with indices, right? So again, here's another example. This was a very strong balance. It was visibly strong. We can see that we broke that balance in B period. We came back in, and in C period, obviously, it was an opportunity to go long and ultimately yield 20 points or more, depending. Here's another example of a strong balance. Balance was strong out of the open. Again, cracked it in B, pulled back a little bit in C. If you'd shorted that, then that would have been 20 points. So you can say that through this initial back look, a strong balance always delivers. If you keep your eye out for a strong balance, then it delivers. Of course, you have to determine what a strong balance is. Well, the more rotations, I say rotations, the more TPOs there are, so in other words, letters. So in the A period, the more A's they are, the stronger the balance. The less A's, the weaker the balance. So we're looking for balances that have as much A's as possible. Obviously, you have to do some work in order to build what's an acceptable strong A balance, because again, if you look, I think we've got 10 letters here. That might not be a strong balance relative to, say, here I think we've got a good 15 or even 18 letters. You can always check that here because it'll tell you the initial balance range, which was, where are we? Let's see. It tells you the letter range and the initial balance range. So it's about 47 points for that balance. So if we count the A's, we should essentially be able to judge what's a strong balance, what isn't a strong balance. I'm not going to count all the A's. That will take me too much time, but there are quite a few A's there. So you can essentially deduce what you wanted to do. But generally you can pull the information here as well. Obviously it's been put in the form of pippage, so you can see that on both range and initial balance range. You'd have to count it out. So that's a nuance, right, I'm showing you that you can take advantage of however you choose, right? There is a lot more risk there because you need to cover the entire initial balance range. And because you're working with a really strong balance, you've got what we call asymmetric risk, right? Or actually, wrong word. It's asymmetric in the sense that the loss side is going to be greater than the win side, inevitably, because most of these strong balances, you can't get a one-to-one drop. Now, on occasion, you may see that, right? But again, you can't, and you have to cover the full length of the balance, and one of these days, or one of those days, you will be caught out, for sure, right? And you have to be prepared for that, and you have to calculate. So for example, we can see a strong balance develop, crack it in B, pull back a little bit, and if you shorted this, you didn't really get your full 20 points. You got about 16, and this thing started to cut back, and eventually it traded above the balance high. Right, so those are little nuances that you need to take into consideration when you're trading an index, is that the initial balances, the strong ones, can generate significant profit over time as long as you're consistently targeting those balances. Now, in my opinion, there's a better way to do this, right? And it's going to involve segmentation of your profile, and we're going to do that very shortly. So first and foremost, using my trifecta. Now I've given you a nuance, and you don't need to use this nuance as a trading mechanism, so you don't have to trade the nuance. What you could do is use the nuance to give you a clue as to what the market is going to do at the open, and you're going to see the trick. This is what I do. First and foremost, let's take today, right? So we're working a lot on the right side of the chart today. So this was the high going back 1, 2, 3 days. So first we're going to take into consideration, right, let me make sure that, so this was yesterday, this was the day before, and this was the day before. So before this market opened, you can see that this was the opening print. So it opened within the price action of the prior day and then went up. So what we should have done as traders, as we always say, we take the first part of the trifecta and we go for liquidity. So we should have marked out or annotated where we think stop losses are going to be relative to prior day price action. So the first level we can visibly see going back quite a few days is the W period high, which is where the market traveled from here to here. Right, so this should be clear for everyone to see. And then on the open, the market traded upwards. Right, so again, I'll just pull this so we can visualize. Now, a couple of things, if we looked at prior days, we'd gone up, we'd consolidated over those days, and then we broke out, and then we set the range. Now, on the move upwards, you should have been anticipating a draw in liquidity and a drop back. Now, since I already have this information, if I'm late and then we dropped back and A period we closed here, then I'm looking for a slight uptick, and then I'd want to be short, and I'm looking to get lows of day, right? Or possibly even back to these lows if I'm looking to hold this as a directional move. So the balance gave me a clue. This wide, strong balance reinforced the fact that this is going to be a down market, but also I can see the draw in liquidity. Now, if I wanted to segment this further, I could do. So I could say, well, I'm going to mark out or annotate my chart, and then I'm going to reset this so that I'm going to look at 1 hour profiles, with 5-minute rotations, and that means I should be able to drop this to about 200. Same start times, and then let's see what we get. Right. So this is what that would look like. So let's see if we can find today's price action the way it started out. So we can see that here. Okay. So this is a 5-minute. Now this is a little bit too wide for me. So I'm going to reduce the size and I'm going to bring it in a little bit. Let me say I'll bring it into about 800 and then I'll work my way down here. So of course with this TPO tool, since we're using the MetaTrader scale, we need to be able to adjust the tool to mirror the volatility we're trying to see. Now this feels a little bit better, right? But I also still think that I can play with this a little bit more so that it's absolutely perfect. So that's telling me maybe somewhere around 500 should give me the view that I want to see. Perfect, right? So this is looking pretty good. So this was the price action, right? So that was so we're going to try and mark this now so we can see the price level. Right, so we can see that move. And we're going to go back to the higher day. Unfortunately, I don't think I can see that higher day because of lack of data. Right? So I can only see the prior day. But so if I'm going to go back, I'm going to mark out that level with, actually, let me see if I can see that prior day level. And I can put the price in. So it's about 40,000. I'm looking on another screen. It's about 40,143, give or take. So it should be about here somewhere. Right, or maybe even a little bit higher. But as an estimate, I think, actually, you know what, I'm going to check this properly. Give me 2 seconds. Let me resegment this. And I'll check that price and I'll mark it out just so we're looking at the correct thing. Daily. 1 hour. Go back 2,000 on the scale. And let's go and readjust this so we can see. So it was dead on. Right, so we're going to put that here for argument's sake. And then let's go back and resegment this. So we go 500, 1 hour, 5 minutes. Perfect. So we can see that price level, right? Even though we don't have the price data, we can still see the price level. So if we're going to trade this now, this is interesting. So this was the opening print, right? We can see that was a really strong 5-minute opening print, and then we continue to break higher, and then we all of a sudden we start to break down, and in H period we'd cut to the downside. Now a couple of things happened here, right? When we did this break lower, we can see that we had minus development inside of the smaller rotation, which is a good place to set an order to sell. So any pullback, in this case in J period, we had a pullback, would allow us to get short and tighten those stops and get the maximum run, right? And where did this eventually take us? It broke us down all the way to the low, which is where we'd want to get out of this trade. Now this one should have hopefully made sense to everyone almost immediately. Right, so the opportunity came at the opening print. Right, and we can see that quite clearly with that huge push and all that tail action that we're seeing that set the A period range, which is this entire profile here that we've segmented down to, right? This entire profile was that A period range. So you didn't need to miss out on the entire move. You could have caught this as it was happening. And then you could have traded that now more efficiently, because when I split the rotation, it becomes exceedingly clear that there was a big move up and there was a big move down. Now this should cement something for you, right? This should really start to nail something in your head. And it should start to tell you that people who say that you shouldn't be trading on the intraday and you should only trade long term are absolutely nuts. Because not only would it have given you good positioning to see this move up, see us break back in aggressively back into the trading range of the prior day, which is what this move is. It's you coming back after we've sucked on that liquidity to the upside. And that's your confirmation that this market is probably going to tumble. And it would have allowed you to get into a good position. And if you were wrong, you would essentially get a good position, which is about 80 points, give or take, 86 points on the Nikkei. And then that would have put you down for God knows how many points all the way to the low. That would have been a great move. It would have been an amazing move. Unfortunately, I can't show you past data anymore, so we have to work with current. I can only show you up to about 2 days worth of data. But since that's all we got, we're going to keep working with that, and I'm going to show you one more example using the Nikkei. So let's go back. So we're going to put in So we're going to do the same thing, right? So let's say, for example, we're looking at this day. If you split that rotation, you should be able to see quite clearly some of the internal liquidity that would have occurred. So for example, this was the market open A period. We traded above and below. So again, if we mark this out, we can see that by the time we got to end period, we can see where that liquidity is. So we're going to now go back and go back to segment to a lower time frame. All right, so if we look back, we can clearly see that these are the prices. So we need to locate. So that was today's price action. If we go back, we can see very clearly from the start time. So all you need to do is select the start time. So we started this at 0300, right? So that was the initial start. And then you can see us trade above and below that. So your interest rate, these two profiles here, right? So you can see that was the imprint. That was, and then we traded above and then broke down inwards. And then we traded lower and then we broke upwards. So this was an end period and this was a London open. Both these would have met our time trifecta, but also you would notice that we didn't get a lot of movement in Asia and a lot of the movement came in London and subsequently the Nasdaq open. So it just depends on where you sat. So again, with indices, you find that you're trying to see where the market is trying to come from. Are they coming from a pre-market? In the case of the Nikkei, are they trading, London, or are they trading the Nasdaq? If we split the London rotation, you can see we traded above and then we had this aggressive break in I period. And again, we've got that minus development here. And that's a good place to sit with a trade. Stops above the high, that was about 50 points, and eventually breaking down to the lows, you're looking at about 153 points. Not bad, right? And again, you can see the Nasdaq open, we pulled under, and then we had this massive move back in E period, and once again, we can see that minus development between the lows of F period and the highs of D period. And again, that's a good place to cover on the once we open F period. And that should give you a good opportunity to go again towards the highs, which would be here. Another 150 points, again for about 47, give or take 50 points again. Right, so both these opportunities were intraday opportunities where we were looking at the internal liquidity as opposed to the liquidity from prior days. Right, and then obviously the market cools off for the overnight, and then we open the next point where we go and take major liquidity and then come back down again and retest these lows. Now I can hear some of you asking a question, well, what about the low here? Would it have been a good trading opportunity? And absolutely. So again, you can see, again, we look at time. This was outside of the time trifecta. It was about 4 a.m. So it wouldn't be a time that I would look at. This was about 5 a.m. So again, not a time you would normally look at. But so this would have been a harder trade to make because we're trading outside of those strong liquidity points. For me, this would have been the more relevant point. So again, once we'd gotten down here and we're out of the trade, you'd have to really reconsider whether you wanted to be long or not. But let's say that you'd seen the draw here. In my opinion, there was no minus development, but let's say you wanted to get in, right, on a pullback, and you got in on the line, then of course you're going to be stopped out for about 50 points or so. But then right after, you can see we came back to recover the line, right? So again, that would have given you an opportunity to look at a trade maybe at this point, and then look for stops just below the lows. And again, that was about a 158 point move, right? For risk, roughly about 40, 45 points. So that was a trade here for sure. But it would have been a bit fiddly. You would have had multiple trades in just to catch this. So again, it's timing. I always say the time trifecta is really important, so just be aware of time. Obviously now we're coming into that NASDAQ in about half an hour, and that should present a better opportunity for you to consider. For example, we've put in a no internal low of day, and that will also allow you to look at prior day lows. So if we take a step back and just go back to that longer time frame now, because I bet we've all had a bit more of an idea of what we need to be doing. Just going to pull this up. So again, we've got the lower session. We've got the lower session right here, right? So that's going to be interesting. But we also have those prior day lows. So again, we can't write this off as a potential place for the market to reach to. But remember, we tend to never be, with a strong balance like this, we tend to never be able to do more than say 1.5. So the likelihood of us trading these lows is actually quite slim today. So instead, the more relevant low is what we've already traded and then pulled back, and it looks like we're going to come back and take out the liquidity even lower. So in other words, what I'm saying is that you'd want to wait and see if we get a reaction when we take out the E period low, or are we going to go straight down and take out this low on the NASDAQ open. Now we know there's been, I think, Chairman Powell's speech at some point, so there might be that scenario developing when the market's open. We don't know. So again, this was a good trade. Now we're trying to speculate to see if we're going to get this low, and then we'll look for a reaction out to that low. Once again, that reaction may well be suited to, say, tomorrow, because we might not be able to get down there all the way today, but we might see a spike down tomorrow and then a rally. So there's a lot of nuance. I find indices are much harder to trade. There's a lot of things that you want to consider just because session times keep changing. The relevance of, like in currencies, for example, that Asia, London, US, the relevance of those opens, they kind of stay very fixed. Right? On an odd occasion, there will be more priority given to one session than the other. But mostly speaking, if you're trading cable, you're going to get more movement out of Europe and Asia for sure. And then, of course, US, you get those moves related to the US market. So it just depends, right? But with indices, you know, your one moment pre-market is really heavy for a couple of days, and then all of a sudden, without any warning, regular trading hours are more priority, and without any warning, within regular trading hours, Chicago becomes more priority than the NASDAQ open. So they're really difficult to gauge. But again, if you focus on them from a distribution standpoint, it should give you a bit more of an edge. And it's one of the reasons why I prefer asset classes like the Nikkei, because that change is there, but we always tend to get a busy Asia open most of the time. Hopefully that made sense. I was going to look at the NASDAQ and the Dow as well as an example, so you can see, but you should be seeing a similar behavior. And this is a segmented NASDAQ as well, so you should see a similar behavior when it comes to drawing on those liquidity areas. But again, we'll look at the NASDAQ differently because there are some nuances here, and also the Dow Jones, the S&P 500, there are all some different nuances. So point in case, guys, just something to be aware of. I know in the last lecture we did a lot about cable, and I did promise that I was going to show you guys some stuff around cable and P&L, but again, you've seen a lot of P&L stuff, so I'm not going to labor and go down that route unnecessarily, right? Because I think we're looking a lot now at indices, and I'm going to be covering this a little bit more, and we're probably going to push a lot more attention to indices because I haven't given that a lot of attention. But any question, guys, leave them in the comments below. You've seen the Discord server, so you can link to that. It's flashing at the bottom of the screen. If you want to DM me, ask me questions. If you want to get access to market profile tools, just let me know. All of these are available in the description below, so you can just get in touch with me. Hope you enjoyed the lecture. I'm keeping this one short and sweet today, but we will, on the next lecture, we'll dive into a little bit more stuff as well. But hopefully that initial insight into indices, coming at it from the perspective of the initial balance, when dealing with the Nikkei, and those nuances as well around balance breaks, also looking out for those liquidities and using the balance as a way to kind of judge what's going to happen, right? And then we can always revisit that on the next lecture as well and see how we performed with the Nikkei, obviously post the conversation. But obviously, judging from what we spoke about, it's very clear, and as I said to you, it's very clear that we're probably going to try and attempt at least to take out the E period low. That's my feeling, of course, and we may well even go to the low of, say, 3 days ago. Not very likely that that might occur, but with all the news, it may yet still occur, and we'll come back and review this. But any questions, guys, let me know. But till the next lecture, adios.